So we can go ahead and talk about one of your favorite companies, Lori.
Yeah, I am a little biased.
Little bias, and we actually, I should, in full disclosure, I mean, I may pick on Apple from time to time, but back when I worked on the Better Investing magazine staff, almost everything is done in the production of that magazine on Apple. And I was the person on staff that actually did both, so I was like ambidextrous. I had a PC on one hand and an Apple in the middle, and Kurt actually fit me up with a machine that would do both for a while. This was 10 years ago, guys, so this was really rocket science at the time. So I mean, I love them too. I mean, the Quark Express product for publication is one of the preeminent things, and it continues to this day. I mean, our son is in audio visual. He's basically wants to be a movie maker, and a lot of the video stuff is Apple at the collegiate level. So it's definitely leveraged in a whole bunch of areas. That's what we're going to talk about. I thought the two Apple logos was kind of a reminder of this is a company that has innovated and changed pretty heavily over the last several years. This stock selection guide is going to look a lot different than some of yours out there, because take special note that again, we have a couple years of forward-looking forecasts here. If you play with a traditional stock selection guide, traditional one which basically stops somewhere right along here, so that's your most recent current year. I don't know what kind of numbers you guys are using out there, but that trend line is basically like this, right? And this company is not going to continue to grow at 40%. All right, it's just not going to do that. In fact, I'd bet the mortgage that it won't do that. It simply can't. This is a company that has reinvented itself, entered new markets, really changed the mix of everything. And what I'm actually doing or demonstrating here is something that we witnessed on a number of guides prepared by Mr. Nicholson in his tutorials, where, especially when dealing with an exciting growth situation, he really placed an awful lot of emphasis on the right-hand side of the page, basically ignoring the history that was more than a few years old. And this takes it to an extreme, but I really can't sink my teeth into anything other than the last two numbers on the right, the two forecast periods, and a growth rate somewhere in that 20% range, and that's what you see down here. So again, I'm thinking 20%. This is a relatively large company in terms of annual sales. You see the $100 million number there. We are going to talk about how to place that in context here in a minute. But when you actually look it up on Manifest, you'll see a number of 17.7. The reason that the 17.7 is there instead of 20 is because of this little critter right here. And that is a representation of the value line analyst's forecast out for the 3 to 5 year period, basically end of September 2015. And it basically drags it down to a longer term outlook of 17 to 18%. So that's the number that you actually see right now, so 17.7. Profitability, this is, we talked at one of our more recent sessions about watching for changes in business model, watching for changes in capital structure by tracking the trend of long-term debt or the trend of shares outstanding. This is another place where you can spot changes in business model. And we had a tremendous example of this about 10 years ago. In fact, we had two at the same time. We had Qualcomm back about 10 years ago that changed their business model fairly dramatically, where they went from a hardware business to where they focused in more on the royalties, and literally their profit margins went from like 2%. I'm just throwing numbers. I don't remember the exact numbers. Their profit margins went from like 2% to 20% overnight. And then back in that same time frame, you may remember a particularly infamous company that went by the name of Enron. And they changed their business model also. And they got involved in some really weird stuff. And a really wonderful natural gas company went from 5% margins to 1% margins, literally overnight. And you can actually watch for those changes in business models. And I think that's what we're kind of seeing here with Apple. I mean, their profit margins back in around the turn of the century were low single digits. And now they basically, what are they? Are they a computer company? Are they a phone provider? Are they a music box maker? You know, they've actually entered into a whole bunch of other stuff, and they're doing it right. I mean, there's no other way to say it. They're doing it right, generating tremendous margins, and you have to give some thought about the sustainability of those margins based on the things that they are developing and attempting to participate in. But they're obviously no longer just a personal computer maker, even though they make some pretty good money on those too. So I would look at that, and we can talk reasonably about profitability, net margin levels in the high teens. Applying it to the equity analysis guide, again, relatively large company, a trailing 12 months, they're a $90 billion company. Here's your fill in the blanks, 17.7%, your margins at 20%. And again, here's kind of the sticky point. If we assume a PE ratio of 19, you could argue within your, and when I say argue, I obviously mean constructively debate. You could argue within your club for a number slightly less than this, but I think it's a pretty good company. I mean, it certainly belongs somewhere in the teens, I would think. And under those three main assumptions, a 17.7% growth rate, which again is an extreme challenge. They have to jump through some really good hoops to continue to do that, achieving these wonderful margins, which obviously other people in the world would like to have also. There's probably some kid in his garage trying to figure out what he can do about that. And decent valuation, you can see that, again, we're talking about a company that kind of audits and checks out in the 20% range. Okay, so that's the second company that kind of jumps off the pages that's triggering a lot of interest. One of the things that I'd kind of like to take a moment and address, you know, with that 17.7% growth rate, we classify Apple as a small company, and some of you, that actually causes you to break out in hives. So how can you really think about Apple as a small company? And the answer to the question is because they really are. You know, it's a $100 billion company, but they're behaving. Underline that and bold it. They're behaving like a small company with tremendously rapid innovation and, you know, improvements in everything that they do. They're behaving like a small company. And the other thing that we like to draw people's attention to, this is a little bit dated, but this is kind of a fun thing to do. Go out to the internet and Google market share stuff. Look up, you know, Google Images or whatever, and just kind of find some market share statistics. And when you take a look at, and again, these guys are not just a PC company, but on the PC side of things, they only have 9% of the market. And many people have actually told me that they think that number might be as much as twice as high as it ought to be. So again, do your research, but take a look and you're going to find single-digit market shares. And they're also operating in all those other things, that music environment, the phone environment, so they're basically playing in this very, very large pond, and they have a relatively small share, even though they're a $120 billion company. Now, I know some of you really struggle with that, but that's you want to think of it in those terms, especially as it relates to portfolio design. And one of the ways I thought I might make this point, maybe I'll confuse it a little bit, but this is kind of the way I look at it. This happens to be a listing of, this is straight out of Solomon, a listing of integrated petroleum companies. And this is another area where some of those age-old guidelines of, you know, a company's a large company when it crosses, you know, $5 billion, that just ain't so in all cases. You know, focus in on a company like, well, we could pick one, but let's pick on, you know, Dan Hess. You know, Hess Corporation, $37, $38 billion company. Are they a large company? And the answer is actually, you know, even though they're in that threshold of being between large and medium-sized companies, they're still a relatively small company when you compare them against some of these other numbers. I mean, look at what the size of this market is. These $300 billion, $400 billion companies. You know, and you know, there are companies that have you know, elevated growth rates. Look at Marathon Oil, a couple notches down here. You know, behaving like a medium-sized company, perhaps even approaching small, and they're a $78 billion company. So again, all the point that I'm making is you have to consider the market. You know, what's the pool of opportunity that these companies are participating in. And then take a look at some of these elevated numbers. Did you realize these were the case with a couple of these? I mean, these are $200 billion companies behaving like small companies, and you know, there's a key word in all of them. You see it right here. They're all Chinese, and again, we're talking about a mammoth field of opportunity as perceived by the general markets, and again, a multi-hundred-billion-dollar company could literally be operating as a small company, and I really think that's what you're seeing with Apple. If you think about them just as a computer company, that $120 billion number looks really big. But when you think about all the various markets that they're trying to compete in, all of a sudden you come back to those single-digit market shares and you realize, wow, they have an awful lot of winnable opportunity out there, and we can actually, you know, frame our thoughts around them as a relatively small company.
I guess, Mark, Don Lino was wondering if you had any thoughts about why their shares have been going down for the past month.
I really don't have any idea other than they have, we'll take a look at a technical chart when we get done here. They just may have topped out momentum-wise a little bit, some of that so-called profit-taking from the institutions. Before we came on the air tonight, Lori and I were talking about, I went to a webcast with Jim Cramer today, put on by E-Trade, and Jim Cramer has turned kind of cold on them. He really thinks that they're vulnerable to some huge institutional stakes in the company, and that there is some vulnerability there. So we'll try to remember to go and take a look at a quick chart, see if there might be a momentum waning type situation there. But this is a company that it just bears being cautious with. Anytime you have a company that behaves like a small company, you can have fairly rapid and fairly substantial moves in price. Let's wrap up.
All the tech stocks were down for the past month, though, also.
Yeah, you got to place it in that context too.
Yeah.
Okay, so we can take a look at that.